Today, folks, we're going to review all the data that's leading hedge funds, the likes of Michael Burry, to discuss the super mega bubble that could continue to crash the stock market upwards of another 50%. Then we're going to review my $434,000 dividend stock portfolio to see where we sit this week with the individual positions. And then finally, I'm going to flip the coin and we're going to take a look at the positive data that puts us in this weird twilight zone, something I've never really experienced in my entire investing career. So to kick this off, taking a look at the S&P 500, first and foremost, the last 5 years have been one of the craziest roller coaster rides I think many of us have experienced. It still looks like we're in this uptrend, but you never really know where we're going right now. And I kind of missed the surreal times of going from the 2008 financial crisis to pretty much 2018. I started investing in 2014, so I was able to capture a lot of this, but the steady Eddie days are completely gone, and the TSX on the Canadian side of the border is falling very similarly in line. But this is leading, this recent little bull market we've had through January is causing more margin in the market. So people that are gambling, basically, as I call it, when you take out debt in your margin account to buy stocks, I think it's a bit risky here in this kind of market, because we can see we bottomed out in December at about $606 billion, where today we're back up to 641. So $41 billion was added. People are getting really frothy with these gains here, but that could change at any moment, right? We're seeing the likes of Facebook, all these big companies do massive layoffs while at the same time doing $40 billion in share buybacks. Don't know the morality behind that, but clearly people are getting a little uptight about the market conditions. If we take a look even farther from a personal savings rate, this is what has most of these hedgies concerned. I mean, you look, we're at historical lows, things we haven't seen since the 2008 financial crisis when it comes to personal savings levels in the US. And I'm sure you're experiencing them. Let me know if your savings accounts are a lot lower than they were coming out of the pandemic levels, right? When the government was just throwing helicopter money around. Continuing on, the debt, this is another thing. Credit card debt is at like a record high here, something we haven't seen in a very long time. So people look like they could potentially be getting very strained, and those market conditions are going to start to bake in to corporate earnings. That is the big concern with most people. And even taking a look at variable rate mortgages pressuring the market, forget credit card debt and savings here. I mean, through 2021 into 2022, over half of all mortgages in the US were variable rates. So there's a lot of people getting squeezed right now, and I think we're starting to see that even with the likes of Apple here. I mean, for the first time since 2016, Apple's revenue dropped off. Their net sales went from 124 billion almost to 117, and this is something very fearful from a price to earnings metric. What we're looking at is Apple's charts from their earnings per share. We got the stock price up here and the PE. If you don't know a price to earnings multiple, it's just basically how long, if I invest today, how long will it take me to get a full rate of return in the company. We pay higher multiples for companies that are growing, which Apple did fabulously basically for the last 5 years, leading to a really high PE. But now that growth is falling off, the EPS is falling off, the revenue is falling off, yet the PE is still trading at 26. Is Apple worth a 26 multiple? Is it worth getting, waiting 26 years to get a full rate of return on a company that isn't actually growing right now? That's something that I think people are going to start to pick up on if we continue to see this trend quarter over quarter. These are the concerns driving a lot of the hedgies to freak the F out, but we're going to talk about the flip side of the coin in a moment. But analyzing my portfolio is currently sitting at around $401,000. I'm up about 2.8% and sitting on almost $34,000 in cash, and I haven't been investing anything as of late. I mean, since the beginning of the year, I really topped up TSM. I bought some indexes, but now I just want to hope that the markets pull back as we head into tax season, because once I finalize up my taxes, I really want to max out my tax advantaged accounts. So I'm just sitting patiently watching what's going on, and I have a very aggressive goal to try and get to about 14 to 15,000 in annual dividends by the end of this year. And it's going to take a lot of prudent and just timely investments, in my opinion, by cost averaging into SCHD, VDY, just these higher yielding stocks. But I want to continue to buy these when they're on the dips. And I think in this kind of market environment, the most prudent thing you can possibly do is highly analyze your expenses and do everything you can to bring them down and continue stacking cash. So to help you do that, I've launched extra spreadsheets at portfoliospreadsheet.com. So we already sell the portfolio trackers. Many of you are using these. Thank you. But I recently just launched personal finance finance spreadsheets, and I'm going to do specific videos on my own personal finances to help motivate you guys utilizing these sheets. If you want to support the channel, really fixate and help propel your financial future, I think these can really help with your goals. Use coupon code dividends, you'll get 30% off. But let's just quickly analyze the individual positions. So VOO following in line with the market, down this week about just under 1%, and we're starting to see more shifting going on with the market volatility, leading to new S&P top 10 companies. Tesla finally made its way back into the 10th largest company in the S&P 500. Meta's been waiting its way back up, but these positions I'm expecting to continue to be excessively volatile and be constantly swapping in and out, which is why I still think it's really prudent to be getting your index funds rather than perhaps overly aggressively buying individual stocks, because we just don't know what these are going to be doing in this market cycle. VDY currently down about 0.54%. This one doesn't do a whole lot year to date. I mean, it is up 6%, but it'd be nice to see this thing continue to pull back so I can cap in a much higher yield on my invested capital. SCHD, similar moat here, not really doing much. Over the last 5 days, it's pretty much flat. Year to date, also just pretty much flat, but again, I like when they come back. TSM is taking the biggest hit. The largest single stock position I've ever held at scale here has been much more volatile, and since Warren Buffett announced that they pretty much liquidated 80% of the position, the stock is coming down. I'm not selling any of it here. I'm not really buying any of it just yet. I'm just watching it, keeping an eye on it. Still up 21% year to date, and they posted really great, I think 16% revenue growth just at the beginning of January. So this company I'm just holding. I still like the position, and I still think it's going to be relatively recession proof with just the importance and the security risks globally this company holds right now. So I'm still waiting on it. I think it's $100 stock, and we're just going to see if it can get there over time. We'll see what the next few months bring. And my best performer this week has got to be my small cap Aduro Clean Technologies, the company that's claiming they can turn waste plastics into fuels, changing the incentive structure behind how we deal with recycling, which over 90% of recycled plastics don't actually get recycled. So I like this one as like a dream shot. I really want this company to change the world, so I like holding it here, and it's nice to see that it is getting some momentum as well. But moving into the positive side of the market here, just getting into it with inflation, the numbers were higher in January, but overall they've still fallen off a cliff dramatically. You take a look at anything on the commodities chart, from lumber, I mean, you can take a look at natural gas, gasoline, wheat. Like, we are out of the inflationary bubble. Now, nothing's saying economically things could change and redrive them up, but for the time being, I just don't see this going back to where it was. So inflation's done and over with. That's one of the positive pieces of data, guys. We're taking a look at employment. Even though savings rates are down, credit cards are up, presuming unemployment stays high, and these are the Canadian employment numbers, which were at an unexpected high in the last report. This is what's going to cushion the blow to a lower savings rate and higher credit card debt. If so long as jobs and employment stays good, the market conditions could see a soft landing. But if this ever pivots the other way, oh boy, with those variable rate mortgages and credit card debts, we're going to be in big trouble. So I'd really keep an eye on the employment reports. And then finally, something that I've mentioned a lot, the markets are pure fugazi, and it really kind of just comes down to where the money is going. And money market funds from big institutions, they're mostly sitting on cash. In fact, they increased coming into the beginning of February here to $9.9 billion to a total of $4.8 trillion. Is just sitting in cash and money market funds from government, even retail and institutions. These are at record highs. So the fact is there's just a lot of cash out there, $4 trillion that at any point in time could really start flowing into the markets. And that's something that, we'll see how it pans out. Because again, even though we head into a recession, doesn't mean the market can't keep going up, which is why it's usually more prudent to be cost averaging consistently. But as somebody that wants to outperform the market, I try and strategically buy when the market takes breaths. Back in October, went really aggressive. In January, went really aggressive on TSM when it was trading around $75, $80 a share. So we'll see if that was a good investment or a bad investment, but I always like buying the lows rather than cost averaging at the highs. And again, eventually when the market turns around and we get back to just regular, returns, that's not going to work best to my favor, but I don't think we're in that market condition yet. So I'm just playing it the best that I can here. And I'd love to know what you think about this in that comment section below.